2, 1. Hello, everyone. Welcome to episode number 3 of the Guidance Accounting Podcast. Hope all is well with all of you out in listener land. Wanted to introduce our speaker. Our guest today has a very impressive background particularly in two areas. One is in real estate and one is in golf, it looks like. Our guest today, Mr. Peter Rizzo, is president of Retirement Guardians and CheckBook IRA LLC, a financial services company specializing in setting up self-managed IRAs and 401k plans. He was formerly director of operations for ARP Wave LLC in Apple Valley, Minnesota, and a longtime senior vice president of Coldwell Banker Burnett Realty in Minnesota, a division of Realty Corporation. Peter was also the owner of Desert Mirage Golf Course, which housed the first tee of Phoenix's West Campus. Peter has a Bachelor of Science degree from the University of Minnesota and advanced degrees in Psych and Behavioral Development from the U of M and Arizona State University, plus a Management Development Certificate for the Wharton School of Business. Having 6 kids, one of Peter's passions has been youth sports. He's coached at all levels, from grade school to high school, and has served on various youth athletic boards in the northern suburbs of the Twin Cities, and has been a chairperson of the 3M Championship Golf Tournament, formerly known as the Burnett Senior Classic, and now the 3M Open on the PGA Tour. Besides his family, Peter has a passion for golf, which he's passed on to all of his children. They all participated in junior golf tournaments throughout Minnesota, and some now work in the golf industry. Peter, thank you so much for being on the show.
Oh, I'm happy to be here. Thank you for asking me.
My pleasure. Pete, when you and I first spoke about a week ago and chatted for about half an hour or so, in my head, I'm like, oh, this guy's got so much great information for small business owners, for people involved in real estate professionals, real estate investors. And I thought, we need to have a conversation. We need to get it recorded and share it with listeners, because I think there's a lot here. Even as a CPA, I've been aware of self-directed IRAs for, probably 10, 15 years. But even as a CPA, I was not aware that you could do a self-managed 401k, and there was other information that you'd shared that was really good. So here we are.
The big providers, they like to hide the fact that you can self-manage your accounts. Give yourself the ultimate freedom.
Well,
I guess you could say.
Sure. I suppose for the more traditional financial services companies, they're earning fees or commissions when they're managing the underlying investments within a retirement plan, right? So
correct.
For them, there isn't as much incentive to publicize or get involved in self-managed IRAs or self-managed 401k plans.
No, and that's exactly right. Although we have an awful lot of independent financial planners who are fiduciaries to their clients that set up plans through us, that are our affiliates, that they welcome the ability to take their clients to, various alternative investments other than just one standard book of business that they might have. So it's a very mixed bag of the type of affiliates we have, the type of people that use us. But for the most part, it's kind of an underlying part of the investment community, but it's growing in immense popularity as more people retire and are starting to want to manage their own investments rather than just sit back and look at them grow or decline.
Got it. Okay. Well, Pete, I know in looking at your background on LinkedIn or just chatting, and obviously what I just read, you've spent a lot of time in real estate, sales, management, development, and obviously now you're on the almost kind of the vendor side in terms of offering self-directed, self-managed retirement plans. What would you say? If you look at your firm's book of business, would you say that half the people you work with are somehow involved in investing in real estate, or is it a higher or lower percentage?
Boy, I'll tell you, I'm only guesstimating when I say this. And the reason, the reason I'm only guesstimating is because our clients have complete control of their investments, and a lot of them are very private about it. The only thing that we can guess in is what type of investment they talk about when they call in initially. And they'll call in, and our goal, our initial conversation is to find out what they're investing in and then try and push them to the right vehicle.
Sure.
Now, very often it's a self-managed vehicle is not right for them because they don't need all the control. So we will send them to, just a very common self-directed plan. But I would say right now, the majority of that we see is real estate. Real estate is huge right now. And excuse me for that. I should turn my watch off. I had the ringer in the background. Real estate is very big. Metals, gold, silver, any type of metals is very popular. Cryptocurrency, and then you have an offshoot of people that, have expertise in a certain field, and they want to find a way to, capitalize on that. I'm going to give you an example. Say a trucker who knows the trucking industry might buy a trailer and lease it with his retirement funds, lease it back to the company that, is going to use it, use it to haul. He can't do it himself, but he can, that company can use it and pay him value on that. So it's a very long answer to your question, but it's real estate. Real estate is probably right now the most popular investment that people are talking about that we see.
Sure. So real estate, like you mentioned, precious metals, cryptocurrency.
Yeah.
I think that there are two asset categories that are forbidden, and I think one is collectibles. Am I getting that right?
Well, collectibles with the IRA, with the solo 401k, there's nothing, the only thing that is forbidden is life insurance contracts.
Okay.
But the argument's out on that.
Okay.
And with the checkbook IRA, or any type of IRA, collectibles and life insurance contracts are forbidden, the forbidden fruit per se.
Got it. Okay.
And in that collectibles goes like whiskey barrels, and people have been investing in whiskey barrels. They want to.
So when you see, I presume you're talking about full whiskey barrels.
Yeah, full. It's supposed to be full. Now, if you ever get audited, it better be full.
Yeah, right. Got it. Okay, and something that you just mentioned there, well, I suppose I should throw out the caveat that, we're not, this is for education, this podcast is for educational purposes only, and we're not giving tax or legal advice. And if anyone hears any information that we're sharing here, of course, they should talk, more in depth with their CPA or their attorney, or maybe they should give Pete a call. But you mentioned an example where someone, was a truck driver or had a trucking business, and they used their retirement plan. And I don't know if, I know you have two different products, and maybe before we get into specific examples, we should talk about two different products, because there's a self-managed IRA and the self-managed 401k. And could you give us maybe just a quick example of what are some of the differences between the two programs?
Sure. Well, the checkbook IRA, was our original product.
Okay.
And that was born out of our founder being a very large real estate investor and investing some monies through his retirement plan into real estate, not liking having to go through the custodian every time he did a transaction or every time he got a payment. So he and his attorneys and tax advisors met with the IRS and came up with this formula that actually works, has become very popular. But what it is, it's an IRA, whether it be an inherited IRA or a Roth IRA or a traditional IRA that has an LLC attached to it.
Okay.
Limited liability company, a single member limited liability company.
Sure.
And the IRA owns the LLC, and the owner of the IRA is the manager, giving them the right to make all the investment decisions and do the administrative work for the LLC on the investments. And every time an investment comes in, it goes through the custodian and down to the LLC. Then it just sits there, and that's the only asset of the IRA is that LLC. And that's our main product. You know, anybody can qualify it that has an IRA. You can, and again, as I said earlier, you can do any type of SEP, you know, a traditional, a Roth, an inherited. It's very, and if you have money already in a 401k, traditional money, you can roll it over to the IRA. So it's a, you know, it's a pretty every man and person type product for everybody. Now,
Sure.
the other product is the solo 401k, you know, kind of better known as the individual 401k that is for small business people with no full-time employees.
Okay.
Other than partners in the firm. Whereas if you have two partners, they can have a solo 401k. But what that is it gives you the same 401k benefits as large corporations, only without all the paperwork. And if anybody has ever had a 401k with a small business, they know how much paperwork is involved in it.
Right.
And this was a congressional act of 2003 passing this law to give small business people that same advantage. And the only caveat is you have to have at least $1,000 of self-employment income and no full-time employees that are W-2. They can be 1099 contractors, but no full-time employees. Or you can't have over 1,000 hours of part-time employees in a year.
No, that part-time employee. So you could have 4 part-time employees, and as long as none of them individually worked more than 1,000 hours, you're okay.
Cumulatively.
Cumulatively, okay.
Yeah.
So if you had 4 part-time employees, you'd have to make sure, in order to qualify for the self-managed 401k, you'd have to make sure that in total, those 4 part-time employees did not exceed 1,000 hours.
Correct. Exactly.
Okay. Got it.
And in that plan, we set it up that you're the trustee and you're the custodian, the administrator. You take care of it all yourself. So you have the ability to invest in whatever you like, and it's completely self-managed.
Okay. So going back to that example that you mentioned a few minutes ago where, you know, somebody owns a trucking company where they've got 1 truck or they've got 50, and they use retirement money to buy a trailer and then lease the trailer to their trucking company. Would it make sense for them to do that? I'm sorry, you're going to say something, Pete?
Yeah, I was going to say they could own the trucking company and lease it back to it. They would have to lease it to another trucking company, or be my example, the trucker didn't own the company. He was just an independent contractor. And he had a solo 401k, but he bought a trailer, leased it to a company that he didn't own or have any partnership with.
Okay, that's right, because of the self-dealing rules.
Right.
You can't do that. You can't buy a trailer and lease it back to a company that you have any ownership interest in at all, right?
Correct. Now there's a rule that, you can have 80% ownership and it's okay. We always ask our people to say, play the middle of the road. Play the middle of the road, be conservative on these things. So, it says you can have 80% ownership in the company. We like to say keep it under 50%.
Okay. So you should probably be a minority ownership interest.
Right, exactly.
Okay. Got it. But it sounds like the vast majority of people that you see, that you're aware of using either of these products, tools to invest, are doing so in real estate.
Correct. They're doing real estate and again, it's one of the things that even when the market crashes and real estate values go down, if you have rental real estate, you still have rents coming in.
Yeah,
so,
hopefully.
hopefully yeah. Right now there's but the majority of times we're in something right now that people have never seen before.
That's right. Yeah, absolutely. Okay. Very, very interesting stuff. So, and I think, Pete, with both of these tools, both the IRA or the 401k, you can roll money over, and I think you mentioned or touched on this a few minutes ago, you can roll money over from an existing IRA or 401k plan that you already have, correct?
Correct. If you're rolling it into the solo 401k, it cannot be a Roth IRA.
Okay.
It could be a Roth 401k or traditional money, going from traditional, but it won't let you roll Roth to solo 401k. Now with the checkbook IRA, you can roll a Roth into a Roth IRA. You can roll a 401k into a traditional. It's just the same rollovers as rolling into any other IRA.
Okay. So let's run through a scenario.
Sure.
I'm a small business owner. I have no part-time employees, either individually or combined, that are getting up to or over that 1,000-hour a year
right
number. So let's say I decide I want to do the self-managed 401k, and I've got $100,000 in an existing retirement plan that I want to roll over.
Okay.
So if I want to do that, I would reach out to someone like you, and I would say, hey, I want to set up this account. I know there's, probably anyone I talk to, there's going to be, kind of a one-time setup fee.
Right.
And then there's going to be a smaller ongoing annual fee for annual maintenance, right?
Right. There'll be a fee. And again, I'm not going to say, I hate to use the word reputable, but the companies that have been around for a while, they have the management fee on there. They'll have the management fee on there to make sure that people have the right documentation on a year-to-year basis.
Sure.
There are some do-it-yourself companies that there's no management fee on there, but you're on your own to make sure that you keep your existing plan up to date.
So that annual management fee is there to protect you from yourself.
Exactly. Or protect you from yourself or your procrastination.
Yes. Okay. So let's say I go with the solo 401k, because I believe that product would allow me to put more money into a retirement plan based on the profitability of my business.
Correct.
And I wouldn't have to worry about making, matching contributions to employees, as long as I didn't have all my employees together didn't work a total of 1,000 hours or more in a year.
Correct.
Okay. So I could roll my $100,000 from my old plan into a self-managed 401k. And then so the money, so I go, presuming that money is sitting in some underlying investments in that other plan or fund. I have that liquidated, so it's cash, because I presume I can only roll over cash, not.
No, you could roll over anything.
Oh, really? Okay.
You could roll over in kind. What you would have to do, I'm going to give you a quick example. Say you had a stock that you owned in your plan.
Sure.
And what you would do once your solo K plan is set up is you would open up a stock account. Now, both Ameritrade and Charles Schwab are very friendly to self-managed plans.
Okay.
And so I'd say the majority of our clients use them. And not saying the other ones aren't good, but they have to jump through more hoops.
Sure.
But those two companies really, have welcomed with, self-managed plans with open arms. And you would open up an account, say at Schwab.
Okay.
And then you would just roll one plan, the stock in from the one plan into the other plan.
Okay.
Stock account. So
sure.
Very, very easy, just like you would any other rollover.
Okay.
And it's called a transfer in kind.
Got it. So somebody could do a transfer in kind utilizing, in your example, Schwab.
Right.
And they wouldn't have to worry about, I own, ABC stock within my existing plan. And while I want to get into maybe investing in real estate within my retirement plan, but I don't know that, but I want to be set so I can pull the trigger, but I don't know that I necessarily want to sell the underlying investments in my retirement plan right now. So they could do an in-kind transfer, roll the stock over, and then at whatever point they're ready to pull the trigger on, actual investing in real estate, where they would write a check from their checkbook IRA, they would then, instruct Schwab to liquidate their ABC stock. So now they've got cash to go invest in that real estate, whatever that is.
Correct.
Okay, got it. How long does it take if somebody came to you and wanted to set up a self-managed 401k plan? How long does it take to set that up?
Boy, if we don't have a government shutdown and everything goes according to plan, we get it done. We get it done in a week.
Okay, so no government shutdown, about a week.
Right, and that for you to be able to go to a bank, open up an account, or a brokerage account to roll your money into.
Sure. Okay. And then how about the self-managed IRA? How long does it take to set that up?
Or for the checkbook IRA, we're going to go, it could be as quick as 2.5, 3 weeks, as long as 4 weeks.
Okay.
Again, rollovers, LLCs, it's a more complicated process.
Right.
In that we're dealing with an outside custodian, that we actually marry the plan with the new IRA. And so there has to be documentation sent back and forth. So it can get delayed.
Okay. So it sounds like if you want to do a self-managed IRA, checkbook IRA, you really should plan on 2 to 4 weeks.
Correct.
Okay. And 401k plan, no government shutdown, we could probably get it done in about a week.
Correct.
Okay.
Exactly.
All right. That makes sense. I just had one of those great deep penetrating questions that everyone would have, and I just totally lost my train of thought. Do you see more people, between the checkbook IRA, married with the LLC versus the self-managed 401k? Do you tend to do more of one than the other?
We do about 50-50.
Oh, really? Okay.
On there. And what happens a lot of times is that, the solo 401k is I'm not gonna say the gold standard, but that's in our estimation the best product we have. But a lot of people don't qualify for it.
Sure.
But initially they'll set up the checkbook IRA. Then they start getting a little bit of gig income, or they retire and do some consulting. Then they open up the solo 401k and roll everything into it. That's usually their goal, to be able to do it. To be able to open the, one gentleman who was going to open up a checkbook IRA, and he started looking at it, says, gosh, I've got to get at least $1,000 of self-employment income so I can do this solo 401k. And
sure,
he went out there and started consulting. So.
Okay, got it. So you could qualify for the self-managed 401k.
Right, because in all fairness, the checkbook IRA is a workaround to the tax code.
Sure.
Where the solo 401k is an actual congressional law. So there's no question marks on anything. Where in our IRA rules, and you are aware that a lot of times they won't tell you what you can do, they tell you what you can't, or won't tell you what you can't do, they tell you what you can do, or we'll just say, here it is. So, there's not a lot of, let me rephrase that. They tell you what you can't do, and they don't tell you, and the rest of it's left up to your imagination.
Okay. Got it. Obviously as a CPA, one of the questions I know a lot of, my clients and listeners would have is, what are the tax filing implications with these two plans?
Okay, with the solo K, there's no filing unless you go to more 250K or more in value of the plan.
Okay.
There's nothing whatsoever. Then after that's a 5500 easy form.
Got it.
And it's the only form that is directly how it's named. It's very easy. A lot of people have their CPAs fill it out. We have a thing online if they want to do it themselves. We always suggest they have CPA fill it out. So they make sure it gets done correctly. And for the checkbook IRA, there's no tax filings. because it's a single member LLC that's owned by the IRA, any tax implication, I think, goes right back to that, to that entity. Now, the only thing you do on a yearly basis is give the custodian a value of that IRA, of the LLC, excuse me.
Okay.
So if you have 4 properties, the last year, the value of cash, whatever you have in there.
Got it. And so when the checkbook IRA client of yours, let's say they've got 4 single-family homes that they're using as rental, what do they use as a valuation number that they give you at the end? And that number is supposed to be the end of the year number, right?
Right.
The 1231 number.
Yeah. I mean, they can go into Zillow, wherever they want to go.
Okay.
It doesn't have to be an exact. The only time it has to be what you would say an exact number from an appraisal is when they take it out, if they take it out of their plan.
Oh, okay.
Any other times it can be a guesstimate.
So
go ahead.
Well, I'm sorry. So what I'm understanding is, as long as they leave the property or those 4 single-family homes that are being rented out, as long as they leave them in the IRA plan, they can use a guesstimate. They could use maybe a property tax statement or something along those lines to determine the year-end value, unless they're distributing out of the plan one of those properties.
Correct.
Okay, in which case then they need an appraisal, you said.
Correct.
Got it. Okay. And then so that IRA that owns the LLC doesn't have a tax filing.
Correct.
And the 401k, if it has assets that exceed, I think it's 250,000, we said?
Correct. 250,000 above.
Then you have to do the form 5500 EZ, and they could either have their CPA do it, or you said you've got the form online, although you
Correct.
encourage people to typically use their CPA.
Correct.
Okay. And then with, I know when you start, when you talk about investments within retirement plans, there's this unrelated business income tax, or UBIT,
right,
that can become an issue. And what can you share with us about that?
Yeah, well, the UBIT, you can't have a business operating within within a nonprofit plan. And it was initially designed, so say the church can't own a Dairy Queen because the church doesn't have tax consequences, so it's an unfair advantage to somebody like you or I, where we'd have to pay taxes on our profits. We would have to pay taxes, employee taxes. So they came up with UBIT.
Got it.
So what you can't do is you can't invest in an ongoing business. You can invest and own an ongoing business with your retirement plan unless you pay a UBIT tax, which is at the trust tax rate, which is quite a bit higher than normal rate.
Got it. Okay.
There's a technique called a ROBS, ROBS, that you can do it with, but that's for a whole nother discussion and affiliate company that we have.
Okay. Well, that sounds like maybe that is another podcast episode.
That'd be another podcast, and I'd give you the gentleman's name who we work with on those. It's a much more complicated process.
Got it. Okay. But so as long as you've got real estate that is, so as long as you don't have an operating business. So if I had a property management company where I had clients that maybe were Airbnb owners or maybe they did, longer term rentals, but maybe you still had to go clean out a unit once every 6 months and paint it or something like that. If I had a company that was doing that, where that's more of an active trade or business, I don't think that would qualify, or if it was held within either the self-managed IRA or the self-managed 401k, it would fall under this UBIT, correct? Is that right? Okay.
That's correct.
Okay. And then that's a whole different tax scenario that we need to be concerned with. And I think for purposes of time and, I don't want to get too down that rabbit hole, but just so anyone who's listening, if you think you're going to take an operating business that's providing, active services or activity, and put in a retirement plan, that's a whole nother conversation you need to have with your CPA before you do that.
Exactly.
There are a lot of consequences involved there.
There are.
And then I know there's this other issue, UDFI, unrelated debt financed interest.
Right.
And so I think, again, because, as you were mentioning, probably, half or more than half of your clients using these two tools to invest in real estate, if they're doing so and they've got products where they've got a mortgage on them, then this unrelated debt financed interest, does this come into play then?
It does. Well, the mortgage has to be, first of all, it has to be non-recourse.
Okay, so it can't come back to the
owner.
It can't be to the individual, right?
Right, the individual or the entity. It only has, the property has to stand alone.
Okay, so
the collateral.
Got it. So you can't have a personal guarantee on the mortgage.
Correct.
Okay.
Or like the LLC, the CheckBook IRA LLC can't guarantee it.
Okay.
Or the solo K can't guarantee it. The only thing guaranteeing it is the value.
Is that piece of property.
Correct.
Okay.
And for the solo K, there's no tax. For the CheckBook IRA LLC, there is a tax on the leveraged amount and on the profits of the leveraged amount. Now, they usually don't, the chickens usually don't come home to roost for a while because and I don't want to get into the whole tax situation on this.
Sure.
This is something for, to talk to your accountant about, your CPA,
right.
That because of depreciation and things like that, a lot of times people don't realize that tax until they actually sell the property.
Okay.
And then they get hit with that. And it's something we always ask people to do when they're say, you were a CheckBook IRA client and you asked me about this investment. And you want to buy a percentage of a syndicate. We then would have you go and talk to who's ever putting the syndicate together to make sure that there's not going to be any UDFI tax at the end of the road that is set up to be able to avoid that.
Got it.
We just did a big conversion for a number of clients that was in a syndicate. The syndicate was going to close down, sell the properties, and it was going to be a tremendous UDFI burden for them. But they were able to set up solo Ks. They all qualified. To set up solo Ks. They were able to transfer the properties into there before the sale, so they were able to, not have that tax.
Okay, so there is a way to manage the consequences of UDFI,
Correct.
but it takes planning and.
Again, that's a whole nother rabbit hole.
That's right. That's right. Okay, but still between the UBIT and the UDFI, just good things for listeners to be aware of, and again, talk to your CPA or your attorney about if you're thinking of going forward with something like this.
Correct.
Okay. Well, Pete, I'm just skimming through the questions that I had laid out to run through during our conversation here, and I feel like we've touched on all of them. Is there any questions that I should have asked that I didn't?
Well, I think that not a question, but I think the one thing that people be really careful of when they're looking at this is they talk to a company that talks to them about the different scenarios and make sure that they're going into the right situation. Because it's just like flipping a house isn't for everybody.
Right.
They watch the TV shows and they see how easy it is. And you put this money in, you tear it down, and my God, 15 buyers come through and, they're bidding each other up. That a lot of times isn't the case. You should know what you're doing. You want to stay in your lane.
Sure.
And, if somebody wants to get into real estate, do a lot of studying or partner with an experienced investor, going down that road. So there's some things you can do, and make sure that, companies just not pushing it into a product, that they talk to you about what you want to do and to find the right situation for you. And if you're going to get a checkbook controlled product, make sure it's really a checkbook controlled product. And that meaning that, you can make all your investment decisions without going through a custodian, that you can collect monies and pay monies out without going through a custodian, that the only time you deal with a custodian is when you make a personal contribution or take a personal disbursement. And so that make sure you're kind of getting the real deal on there. But those are the only things I think, that were important. I really kind of wanted to underline.
Sure. Okay. That's great advice. I mean, it's so easy to, see something on a YouTube video or, hear something on a podcast or, see something on a TV show and you go, oh, that doesn't look that tough. And, you do it. And it's one thing to see someone do it who's done it before or maybe done it many times before. And it's another thing to do it yourself.
Correct.
And, always make sure you've got great advisors that are, walking that path with you. Because, any of this stuff goes sideways, just like anything else, tax related or business related, there can be really expensive, really painful consequences that you may not even be aware of for some period of time, like years.
Oh, God. I mean, we've had a lot of situations. I mean, people, they will go to a do-it-yourself site. They'll set up their own LLC. They usually don't have the right operating agreement. But they're rolling over $200,000 and they're trying to save $500.
Sure.
I mean, frankly, it just doesn't make sense on that sort of thing. So you want to make sure you get it done right. And with the checkbook IRA, having the correct operating agreement with all the codes is the most difficult part of it.
Right. Yeah, I think the one of many expressions to describe what you just mentioned is being penny wise and pound foolish.
Right.
By try to DIY something and then you pay a much bigger price a little bit down the road.
Oh, sure. I mean, you talk to any contractor who deals with, say, Home Depot, that goes in and fixes after the person goes and screws it up.
Sure.
So. Yeah. But that's about it. I mean, I really appreciate the questions and the chance to, discuss this, because that's out there, and I'm happy that you're looking at it to make more people aware of it.
Yeah, absolutely. Thank you, Pete, for taking the time. Pete, if somebody wants to reach out to you and, wants to talk with you directly, whether it's about, checkbook IRA, LLC arrangement or 401k, self-managed 401k plan, or just to thank you for being on the show and for sharing information. What's a good way for someone to reach out to you?
Okay, well, they can email me at Peter, Peter, at checkbookira.com.
Okay.
Email me that way. They can call 833-401-5472.
Okay.
Or they could go on our website, checkbookira.com, and there's a spot where they can book a call from me.
Okay.
They might even catch me on a chat. The owners and we all jump in on the chats on the website once in a while.
Okay.
So we're able to keep our our feet on the ground to see what actually people are looking for. And if you get me on a chat, that is actually me. I always get that question. That one guy went, and I usually, on Sunday evenings, I'll go on and just, check on things on my computer, and the chat will come on and somebody will say, this isn't really you. And I had one guy, actually, I want to call you and talk to you to make sure it's not some bot.
Oh, yeah, right.
That's kind of the popular thing now.
Sure. Yeah, that's right. So, okay, so we've got your phone number, we've got your email address, we've got your website. And for people listening, I know a lot of people, when they listen to podcasts like myself, you're maybe out for a run, out for a walk. You may not have something to take notes on, or you might be in the middle of a conversation, but you hear something. We always put contact information and kind of an abridged version of show notes along with the podcast. So if you find this podcast on Libsyn or Spotify or iTunes, you will find show notes, and you'll be able to see Pete's contact information for his email, phone number, and website. So Pete, thank you so much for being with us today, spending a few minutes to get us educated on self-managed IRAs and 401k plans, and to look forward to. I think you and I will probably be chatting again soon.
Good. Well, good. Well, thank you very much for having me today. I really appreciate you, sharing our information with your listeners.
Absolutely. Thanks again, Pete.
Alrighty. Have a great day.
You too. Bye-bye.